Welcome. My name is James Sackey. I'm the marketing director for the Vant Group and your host for the quarterly Deal Pulse, where I'm interviewing top deal makers.
So I'm a partner with Blank Rome.
So in Enascor, we are a direct lender.
For their insights and their feedback.
I think on some of the sell side, you've got some companies that are in a little bit of trouble now.
On what's going on in the transaction world. Let's get to it. Thank you all for joining us today. I am joined by Paul Iacovacci. He is the founder and CEO of Enascor Capital. Paul, thank you for joining us today. Could you give us a little bit of intro on yourself and your firm?
Sure. It's a pleasure to speak with you this afternoon. So in Enascor, we are a direct lender, but we're highly unique in that we would classify ourselves as contract financiers. And by that, we mean we only focus on lending to companies that have contracts where the wording of those contracts creates distinct and defined multi-year cash flows, and where the cash flow payer, the customer of our potential borrower, is investment grade rated by Moody's, S&P, and Fitch. And what we do that's radical compared to traditional lending, which is backward looking at what you did last year and doing a multiplication of what they can give you, we're actually taking those distinct and defined multi-year cash flows and present valuing them, and allowing the company to essentially revenue accelerate and borrow against those future earnings on a non-dilutive basis. So it's not factoring, which is 30 to 60 day type of financing. We're taking contracts that are typically 2 to 5 years, some in the project finance world, 7 years, and present value in that whole stream and allowing you to borrow against those future earnings, which for most lenders is antithetical of how they lend. So we don't compete against other lenders. We're really the competition for equity. We're one of the very few growth debt solutions a young emerging growth company has. If you don't want to dilute yourself, if you want to have a lot more at the end of the rainbow when you sell the company, if you're in our sweet spot, there is no better financing.
It looks like it's a pretty clever model. I was reading up on the company earlier. So if you're ready, we can get right into it and start talking about what's going on. So what are you seeing right now in the deal flow? Are transactions increasing? Are they decreasing? Or are they just simply kind of shifting in nature?
We're always busy no matter what the situation is, but when you have times and circumstances where equity becomes very dear or very hard to get, we become one of the flavors of the month, because it can take 6 months to 12 months for an emerging growth company to get real equity to the size that they need. Now, if they have contract-based revenue, we can actually do it in a very quick time period, and it's basically formulaic. You can figure out how much we can give you with an HP calculator. The flow, though, has changed a bit. I would say in the last 3 or 4 years, under the previous administration, there were a lot of government programs. You had a lot of programs dealing with the poor, whether it's for rural broadband, whether it's for food for medicine, whether it's unique CMS type programs. Those are I don't want to see being phased out. There is still some. We're waiting for a number to be renewed. But where we're seeing the biggest flow is in the military spending. And it's coming all over the world, all the G12. Everybody's building up. We saw that the U.S. is going to spend $1 trillion on military over the next 2 years. For the first time in history, Germany is pledging $1 trillion over the next 10 years. It's going on in Scandinavia. It's going on in France and the rest of the G6, G8.
Interesting. And so that kind of can swing me into the next question a little closer in time. How have buyer expectations or behaviors changed in the last 90 days?
Well, we don't really deal with buyers because we're not really an M&A. We're really with companies that grow through either through organic or through, mergers, but they're doing mainly stock. So I don't really see that world, except for the fact that I know that M&A deals are not getting done. And so they're coming to me for organic growth.
Interesting. So are you noticing any sort of red flags that are killing deals early on in the process?
Well, I think there's two things. One is because of the nature of our financing and how unique it is being non-dilutive for a lot of these emerging growth companies, we're starting to see a lot of companies come to us before they're ready, meaning that they only have one contract. They haven't really proved they can satisfy and deliver on that because everything is under contract law. If one side provides consideration, the other needs to pay. And that's why we have investment grade payers, because they negligibly default on their vendor base. It's almost non-existent. So we're starting to see companies that haven't even produced their first product yet, or the software is not ready. So it's just too early for us. The other thing is that, and usually at the end of an economic cycle, we start to see this, which is making us nervous. Companies that say they have certain things, or their financials are say certain things, and when you start to get into due diligence, they're not that. And so you don't want to call it malfeasance, but that level of falsity is rising at an ever-present pace.
Interesting. I have not heard that yet, so that's definitely a red flag to be aware of, especially if that's something that's emerging now. And so, are there any particular industries that are most active right now, or are you seeing any particular deal types that are really active right now?
Well, as I said, the military spending, because it's probably the biggest flow of funds as everybody builds up their military again. That's number one. The second is, and we started to see this 2 or 3 years ago, and it's definitely hitting a fever pace, is one of the demographics of one of these industries is in the healthcare space. So if you look at hospital systems, one of the biggest challenges they're facing, no matter if it's a private hospital, public hospitals are in bad shape. The average public hospital is in the red by a big margin, and there's the ever-increasing closings of rural hospitals is an epidemic, because the rural hospitals cannot keep open enough, cannot staff with the doctors, do not have enough nurses. It's bad. And I don't think we're addressing it as a country yet, because you haven't read about it in the newspaper, but I am seeing it in a big way. And anybody that's a practitioner in those rural areas is realizing that they really do not have a hospital system that has financial condition enough to be around. So what we're seeing is, on the software side, these younger emerging technology companies beating out the large incumbents because they have much more advanced AI capabilities. Because at the end of the day, even the public hospitals have operating margins, net margins of 4 and 5%. It's very low. And the best public hospital has a 1% cash flow margin. It's so bad. So a dollar saved is really a dollar earned. So you're starting to see all of these younger companies in the technology space, whether it's how to efficiently manage your patients, how to dispense the drugs faster, how to be efficient in billing. So you're starting to see a cross section, anything that can reduce catastrophic events, which is the biggest expense for hospitals, is being looked at in a big way. And whether it's Oracle, SAP, or any IBM, any of these bigger guys, they're getting trumped by a lot of these smaller startups that have all types of ability to take real-time data and monitor patients on a real-time basis so that they can be alerted if a doctor misreads a patient's chart and puts in a solution in there that shouldn't be in the person's system that could kill them. So we're seeing a lot of that.
Yep. Let's go a little bit more macro. What's one piece of advice that you're giving clients more often this quarter than you were last quarter, if any?
Well, from the borrower side, I think that they need to, if they're looking for growth capital, they need to start out earlier in the life cycle, but not early enough that they don't have a product. Because if we don't do it, if we don't finance them, the speed in which they're going to get equity capital it takes a long time. I mean, it is brutal out there. And a lot of it being that your traditional sources of capital, whether it's the endowments, the foundations, the pensions, they're all hemorrhaging. Venture capital is taking a big loss across the board. They're not getting the realizations. They're not getting the IPOs. They're getting the markdowns. A lot of the investing world that was just based on a whim or the latest fad, they're going out of business. So it's bad out there. So they need to make sure they're prepared.
Why do you think that is? What do you think is driving that?
Well, that changed at the end of 22. when the valuations just got to be on a fever pitch, whether it be AI, whether it be cyber, and there were companies that were just starting with had no idea if or when they were going to be profitable. And people realized that that's a sinkhole. And the endowments, the foundations, the pensions, who were the biggest investors in that world, they were getting destroyed. They weren't getting the realizations when they weren't doing IPOs. And so everybody said, whoops, we need profitability. Oh, well, that was a big come to Jesus moment. You know, well, then everybody, including Silicon Valley, realized half of their portfolios were going the way of the dodo bird. And so everybody's been struggling.
Yeah, interesting times for sure. Hopefully we're going to have smoother sailing. And that leads me to my last question is, if you had to bet on one shift in M&A that's coming next, what would it be?
I think there has to be a massive consolidation. I think that you're going to see a consolidation in investment banks. I think you're going to see a consolidation in AI. I think you're going to see, it's just, there are too many of the same thing. And nobody's really making the money that they should because there's just too much diversification and the talent pool is so diversified. I just think there's just not enough. There are very few industries that can support so many companies in a single industry. And a lot of this is the VC world, the private equity world have been funding this. And I think you're going to see a reversion back to the mean.
Interesting. I share that sentiment a little bit myself, especially in AI, of course, because that's the new thing in a way, as well as cybersecurity probably, and anyone that's kind of getting into that data center space. I think that's going to get some consolidation as well.
Well, the data center space is interesting because I would have, before AI came along, that would have been true. I don't think the data center space is going to see anything but growth because of AI and because of what sort of crypto, but blockchain is creating just a massive need for the computation power. So what you will see in that marketplace is very new technology that condenses the storage capacity so that the same data center can be 10 times more productive. That's what you will see.
Yep. That, and once we can figure out the power situation, right?
So, and the water.
Yep. And the water is cooling. For sure. Paul, I appreciate your insights. This is really good stuff. For those of you that are watching, hopefully you found it as useful as I do. If you'd like to find out more insights from our deal makers, please check out our social media channels on YouTube, as well as our LinkedIn and the website at thevantgroup.com. Thank you for joining us today. Thank you, Paul.
Thank you. Bye-bye.